Good morning, everyone, and welcome to the latest in the Pulse webinar series for advisors. Delighted to be joined again today by our technical support partners, QB partners, when we have David White and Mike Foxall with us today. Running through a theme, we're continuing the theme of estate planning, succession planning, and today the guys will be talking about beneficiary nominations and a whole host of issues that go alongside succession planning with your clients. In all my years of financial planning experience, certainly this is the one area where, when done correctly, gets the most positive feedback from clients. But if done incorrectly, it can trip up and create a whole host of issues for you and your clients. So a really important topic today. As always, there will be the opportunity to fire across questions to us. So if you use the tab at the bottom of the screen, we'll ensure they're collated and the guys will run through those at the end of their session. Today, we expect the slides to take around about 30-35 minutes, and then we'll have the questions straight after. So that's enough from me. I'll hand you over across now to David. Over to you, David.
Okay, thank you, Paul. Morning, everybody. I've got the easy bit today, really, which is I'm going to recap the position on UK pensions, the UK taxation of pensions for UK pensions, cure-ups and QNUPs, which most of you will probably know. But as Paul said, it's very important that it's done correctly. It's very important that we refresh it, and that gets the best outcome for your clients. One of the other reasons that we're doing that is we then want to go on, and Mike will be speaking on this part, to compare and contrast the UK approach, which is under common law, with the European approach, which is under civil law. So I'll set the scene with the UK approach and the common law approach, and then Mike will come in and talk through the civil law approach. So just before we start, for any of you who don't know QB Partners, we're a independent consultancy. We provide technical support to financial advisors and to product providers on a cross-border basis in particular. We support you through initial questions, through your advice reports, through our suitability reports, and then with the implementation of the solution. All of our work is covered by PI insurance, so you give the advice to the client, but the advice that we give to you is covered by our PI. We provide due diligence on any providers that we might recommend, and working with us really helps your advisors engage with high net worth individuals who might have complex situations, but reduces the risk in the business for the owners of the business because you're getting high quality technical support. So sales pitch over, we'll move on to the technical content now. So as I say, I'm going to be covering the UK common law approach. And first of all, why is it important to plan correctly? Well, as we know, from a UK perspective, pensions can be treated very tax beneficially. There's tax relief on the contributions made into the pensions. And that's because the state are wanting to encourage people to provide for themselves in retirement and reduce the reliance on the state. So the tax advantages have been extended from the tax relief on contributions to tax relief on death or tax beneficial treatment on death anyway. And pensions now in the UK are treated as being outside of the member's estate. There's no IHT payable. There is tax on death later on, which I'll come on to. But providing that you follow some very straightforward rules, which we'll come on to as well, there's no IHT payable. The pension is outside of the estate. And why is that important? Because HMRC tell us that a typical estate is £500,000. You've got your nil rate band of £325,000. So that on the difference, the 40% inheritance tax on the difference, that can come to £70,000. I think we all know that a lot of the clients that we'll be dealing with and you'll be dealing with have much higher estates than that. So you can have a significant inheritance tax liability. So if you can use planning to keep assets outside of the inheritance tax net, that's what should be done, and pensions is very important within that. So on UK pensions, death benefits are reportable by the pension trustees to UK HMRC. So on the death, the family have to report to the pension provider. So whoever's looking after the estate reports to the pension provider that the individual's died, and then the pension provider reports that to HMRC. So HMRC should know soon after the client's death that the client's died, and that's where some of the rules come in on the tax treatment. In April 2015, after pensions freedoms and all of that went on then, death benefits from UK pensions was actually, the treatment was actually improved, and there's now no tax charge payable on death benefits from UK pensions until after age 75. So if somebody dies before age 75, there's no tax payable on death, providing that the lump sum or drawdown is taken. The wording is what I've put here, which is 2 years, within 2 years of the notification of the death to the scheme trustees. So on death, the clients should be notifying the scheme trustees as soon as possible. Obviously, by the clients, I mean now the beneficiaries or whoever's looking after the estate. And then they have to inform HMRC, and the benefits have to start being taken within 2 years of notification to be free from tax on death. On death after 75, beneficiaries will be taxed at their marginal rates on any benefits paid to them. Benefits can be passed to a dependents pension, so there is planning that can be done to keep the benefits outside of the estate within a dependents pension. Cure Ops is very similar in terms of tax treatment now. Again, going back to 2015 through 2017, there was equalisation really of the treatments, the tax treatment of Cure Ops, particularly for UK residents, with the tax treatment of UK pensions. But once somebody's been a member of a Cure Ops for more than 10 years and been non-UK resident for more than 10 years, there isn't any UK tax on death. So Cure Ops were originally introduced for non-UK residents, for people moving outside of the UK and staying outside the UK in the long term. And there is still some advantages of Cure Ops for those people. So I know many of the advisors on the call work within Europe, and within Europe, there's still advantages of using Cure Ops in certain circumstances. And that's one of the advantages. If there's somebody's a long-term non-UK resident, then there can be beneficial tax treatment over and above the UK tax treatment, which is that there's tax on death after age 75. So, not giving too much away there, but within a Cure Ops, there isn't any tax on death at all if the individual's long-term non-UK resident. Cure Ops is an area of planning that some of you might have come across, and I think it's worth mentioning in the context of this discussion today, because Cure Ops is important for people who require supplementary pensions planning. So, people might have paid into their pension up to the lifetime allowance, up to the annual allowance. Their pension might be providing, the pension pot might be providing them with an income which is below what they need in retirement. If you look at the sort of lifetime allowance of just over £1 million, that provides about 50,000 per annum in retirement, which for a high earning individual may not allow them continue the lifestyle in retirement that they've had when they've been working. So that's when Cure Ops can be important from a pension planning point of view. And as a lot of you will know, if contributions are made into a Cure Ops, they're immediately outside of the scope of UK inheritance tax. So Cure Ops is sometimes looked at as an inheritance tax planning vehicle. It shouldn't be. For Cure Ops to work, it's got to be genuine pension provision, and you've got to be able to evidence that there is a requirement for the income that the Cure Ops is going to provide in retirement. But if Cure Ops can be evidenced as genuine pension provision, then the assets do come out of the estate from an IHT point of view. There is still within those UK rules income tax payable on death after age 75 where the beneficiary is a UK resident. So you've still got to keep an eye on those UK rules for Cure Ops. So Again, you know, people often say, well, QNUPs is great because it takes all of the assets outside of the estate. It does, but for UK residents, there still can be income tax payable. So it's got to be planned and used appropriately. Okay, so sort of just moving on to a recap on beneficiary nomination. Again, sort of focus on UK pensions and QROPs and QNUPs, which are generally written under discretionary trust. And, you know, back to basics, what does a discretionary trust mean? Well, a discretionary trust means that the trustees have discretion. So the member can't make decisions. That would be an absolute trust, and it has different tax treatment. So the member can't make absolute wishes, and that's where the beneficiary nomination and expression of wishes comes in, and it is really important. So what the member is saying to the trustees is, this is what I'd like to happen on my death. This is the expression of my wishes on my death. But that has to be at the trustee's discretion for the trust to work. In practice, unless, you know, somebody's done something sort of really crazy, then you know, I think I'm right in saying, and Paul can confirm later, that the trustees will normally follow the members' wishes. So it is a little bit of a technicality, but it's a really important technicality to get right. And beneficiary nomination normally avoids probate. You know, probate is gone through when there's a will, and when it's not clear where benefits are going to be paid to. In some cases, that has to go through probate. But if a beneficiary is nominated, then you can normally avoid probate. If no beneficiary is nominated, or if the beneficiaries that have been nominated predeceased the member, then obviously then it has to go through probate. Hopefully there's a will. That's another important part of financial planning that I think we've covered in other webinars. But if there's a will, then the wishes that are expressed in the will will be followed. Just coming on to the form, I don't know if you can see this, if it's a bit small, but this is Novia's ISIP nomination expression of wish. So when you're dealing with the trustees, most trustees now will have this form within their application pack. If they don't give you one, make sure as the advisor you ask for one and make sure it gets completed, because it's really important that this is completed to make sure that there is a nominated beneficiary or beneficiaries, and to make sure that, you know, if the member does die, then things are dealt with smoothly. If possible, probate can be avoided and things will go through smoothly and benefits can be paid out quickly. What it says in the small print at the top of the form here is basically that Novia will take into account the members' wishes, but they have to say in the small print that, you know, it's their decision at the end of the day, and it's the trustee's decision at the end of the day. And that's what keeps it a discretionary trust rather than an absolute trust, which makes the trust work. Okay, I mean, just to finish off on this section on UK pensions and the common law approach, is that because in the UK pensions are treated as being outside of the client's estate, the tax treatment is very beneficial. It actually sometimes makes sense, and this is a bit counterintuitive, but it sometimes makes sense to, when looking at the planning sequence and looking at, you know, sort of cash flow analysis and that type of thing, it can actually make sense to, when the client does retire, to use other forms of wealth to provide the income in retirement, and to use the pension to be passed on tax efficiently to the members' beneficiaries. And I say that's a little bit counterintuitive, but there are other vehicles, other financial planning vehicles that can be used. A general investment account still has tax referral gross roll-up, and you can use that to save. And once savings have been accrued, an offshore portfolio bond can be used, and that, as we know, can provide tax-efficient income in the UK through the 5% per annum withdrawals return of capital approach. So If somebody's got other wealth apart from their pensions, there is planning that can be put in place, still planning for retirement, but actually when the client goes into drawdown, starts taking benefits, they should potentially be looking at these other vehicles to take benefits from prior to taking benefits from the pension, because anything within the pension is outside of the estate and can be treated very tax beneficially on death. Okay, so if there's a question come in, but we'll cover that at the end if we can. If there's any other questions on my section, then please sort of jot them down or put them in the Q&A, and we can cover those off at the end. I'm going to hand over to Mike now, who's going to cover the civil law approach, and that's much more complicated and can vary in different jurisdictions, as Mike will cover on. Thanks, Mike.
Thank you, David. Yeah, it's working. That's good. Good morning, everybody. I'm actually going to start off. We're going to go into the civil law approach. I'm actually going to just revert back to the common law just briefly, because I think it's important to sort of show the comparison and contrast between. So, bizarrely, in the common law jurisdiction of the UK, we talk about inheritance tax, but UK inheritance tax taxes the estate. It does not tax the inheritor. It's basically the estate which goes through a process, which I think we all know and understand, which is probate. There's testamentary freedom if you write a will. Obviously, if you don't, then there's certain rules that have to be followed. And even if you do write a will, there have been challenges in UK courts that have forced changes to that will after somebody's died. So it isn't completely testamentary freedom at this stage. But what happens with probate is you gather up the value of all the dead person's assets, take away their total debts. There's some exempt assets, certain trusts, including pensions, which are usually trust-based. And then everything's basically distributed by your executors, or equally with trustees if they're involved. And it's usually distributed to the beneficiaries after IHT has been paid. So it's the estate itself. You add up the values, you have a nil rate band for the estate, and it's the IHT is paid by the estate. If we then contrast that with what happens in a civil law jurisdiction, and here we're talking Napoleonic Code. Most of Western Europe has followed this sort of concept. Firstly, virtually every country under the Civil Law Code has forced heirship. Now, that basically means that certain amounts of your assets must go to spouse and or children. Now, I'll just give some figures for France. One child, 50% of your assets must go to that child. 2 children, 2/3 of your assets must be split between those two. And you go 3 or more children, 75% of your assets must go to those children. I've got some figures later on around what forced heirship looks like in Spain, and we can sort of revisit that at that point. The other, I think, crucial part is that everybody in the civil law jurisdictions understand products in the sense that they're contract-based. They've definitely preferred the trusts, and as we know, of those of you on the call, certainly who operate in France, the French don't take a very positive view around trusts, so that includes pension trusts. Okay, so contracts are definitely preferred to trusts. Those contracts usually have embedded within them a beneficiary nomination clause. Is that an expression of wish? Basically, yes, it is, but it's contractual with it. It's a clause contractual within the contract, and that's how it works. The tax is applied to the beneficiary on the amount received. And I think that's a crucial part, because if you think in the UK view, you've got this nil rate band of that you then pay tax above that as an estate and the total assets of the estate. But in France, if you're a child of the person who's died, you've got €100,000 tax-free allowance. You'll pay 5% tax on approximately the next 8,000. There's a couple of other bandings in between, but there's a big banding between 16 and 550,000 where you'll pay 20% tax. And the highest rate is 45% in just over 1.8 million, and this is euros. The crucial point to remember is that's not 1.8 million of the total estate. It's literally per beneficiary receiving that amount, okay? So the nil rate band is applicable per beneficiary, and it's based on the relationship to the deceased. So those numbers I've quoted for a French child, it applies to grandchildren and indeed to parents. But for brothers, sisters, nephews, nieces, those numbers are all different and will apply a greater level of succession or inheritance tax. So the crucial point in civil law jurisdictions is actually to understand where is the beneficiary resident, because that is the factor that's crucial for succession tax. So with some caveats to this, if you die in, say, France, Spain, or Portugal, or Italy, and your children are back in the UK, then the effect of the country where you are resident when you die and the tax falling upon your beneficiaries is limited. However, if they are in the same country as you, and depending where they are in that country, that can make a difference. And certainly Spain, where the level of succession tax that falls on the beneficiary will vary by region. So just looking at a couple of the countries independently now. In France, just before I go into the points on the slide here, I think it's just worth reiterating that if you're a resident in France for more than 10 years, and it links back to what David was saying about CUROPS, because if you are holding a CUROPS and you've been living outside of the UK for 10 years or more, then UK inheritance tax won't apply at all. There won't be any tax on your pension. But if you flip that into your position if you're living in France, once you've been living in France for 10 years or more and your tax resident there for 10 years or more, your pension becomes eligible to French succession tax. So these are the sort of factors you have to begin to think about when you're dealing with clients that have perhaps left the UK, moved over to France, Spain, Portugal, etc., and how you're going to help manage correctly how they position their assets. It's crucial in France to consider that trusts and foundations are effectively see-through. They're not like, as I said earlier, the contract structure is something that is much more understood and therefore benefits from much better tax positioning. Now, hopefully some of you are aware that there is an option if you move to France that you can actually surrender your whole pension and you will only pay 75% withholding tax on 90% of the capital payment. There are some criteria around that. In fact, there's a lot of criteria around that, but some of the most basic are that where the pension is from a foreign source, which it would be in a UK expat situation, there must have been a tax advantage during the accumulation, and that can be proven. And the pension must be taken as one single lump sum payment. This is not something you can't start doing a drawdown situation. This has to be the whole pension, and you can effectively end up with a 77.5% withholding tax. What would be the logic of doing that? Well, it might be to reinvest into a structure that possibly better suits the French tax model, so assurance vie. There is a reason why virtually anybody with any decent amount of wealth in France has an assurance vie. It's because it produces really good positive tax outcomes. So tax deferral, only taxed on the growth element, 30% tax, and compared to an open portfolio, a general investment account, which you can end up hitting taxes up to 60%. So the other main reason for an assurance fee is actually around succession tax planning. As long as you subscribe the policy before age 70, as I said earlier, it's a contract. It comes with a built-in beneficiary nomination clause. That can be changed very easily. It's just about telling the provider. And you've effectively got a 50% reduction on succession tax in France for direct line beneficiaries. Straight away, you can see that the nil rate band there goes up to 152,500. And then the maximum tax you can pay through the structure is 31.25. If you consider the nil rate band per beneficiary is 100,000 without that structure, and potentially you can go up to 45% if it's a sizable receipt from the estate of the deceased. Portugal is probably about the easiest country to deal with around this matter. You'll all be aware of the non-habitual resident regime. Primarily, that is an income tax benefit regime. You've always got to be aware that capital gains taxes on worldwide assets is still payable in Portugal. But as far as succession or gift taxes are concerned, they don't exist in Portugal. Now, beneficiaries can sometimes pay 10% stamp duty. There are currently exemptions for spouses, descendants, and parents. So there's potentially a little bit of income tax payable on certain assets as well. But again, the life policy, the contract policy tends to favour above sort of pensions around the fact that there's no stamp duty at all and there's no personal income tax on final surrender. But in fairness, in Portugal, the regime seems to understand and consider pensions. It's one of the main drivers of the NHR is that people retire there and pay very little on their income tax on their pension benefits. So, you know, that is at the moment, Portugal is a jurisdiction where I think we can usually advise fairly clearly on these matters. Spain, much less so. Sorry, there may be some words in this. Oh, okay, I'll just build it all, it's easy. There is definitely some confusion around the taxation of pensions in Spain at the moment. We've had probably 3 or 4 inquiries in the last 4 to 5 months that have suggested, well, there have been some rulings by the Spanish tax authorities that were best to be described as unexpected. And people who are trying to transfer between different pension structures are being hit with potential tax outcomes that are very unfavourable and certainly not what we would have expected. So there's quite a bit of work going on in the background around this at the moment, and that's a one to sort of watch and wait and see. On the inheritance side of things, I think that is still clear. It's more about how things like SIPs are treated in Spain. That's where some of the issues and transferring from certain jurisdictions, structures in certain jurisdictions to others that are creating the problem. But as far as succession taxes are concerned, that's, I think, is still fairly clear. You've again got the law of obligatory heirs, and 50% must go to spouse. There is no spousal bypass in Spain. There is in France, but not in Spain. And then the other 50% is equally divided by thirds. And I think this sort of really well describes how forced heirship sort of tends to work. So a third of that other 50% must be split between your children equally. You can then split another third between them unequally, is the best way to describe it, based on whatever you've written in your will, and you can favour and disfavour various children. And then you've got a third which is free choice. So as you can see, that is pretty much driven a little bit like the French model, where 3 children or more, 75% must go to those children. The IHT rates in Spain are set by the national government, and they're progressive up to 35% of tax for a beneficiary, again, receiving more than 798,000 euros. However, in most regions, a 0 rate has been set for spouses and children below the age of 21. Andalusia is not one of those regions, so there potentially is tax to be paid there. Again, think about not where the client is, but think where the beneficiary is going to be resident. There's also some, again, just mentioning insurance policy, there is some favourable inheritance tax, but you have to be careful whether that is set up as a whole of life, or sometimes in certain of the regions, you might be better off setting that up as a term policy. Certainly that, again, thinking about where the beneficiaries are resident, not just where the client is resident. So in conclusion, some key IHT factors if your client is now resident in EU jurisdiction, and especially if they are UK expats. The first one is that the UK domicile, we've covered this in a previous session with Novia in one of these, the webinars. And it's very clear that based on your UK domicile, the IHT arm of the UK revenue has a very long reach, and long not just in distance but in time, and it's very easy to think that you've got rid of your UK IHT because of you've somehow lost your domicile. but it's very difficult to lose that domicile, and it will come back to bite clients if they haven't considered it properly and worked through and understood what the basis of the UK tax could be at the point of their death. Moving to the civil law, IHT and gift tax, as I've stated, falls on the beneficiary. And it's crucial to get that into the client's head, that it's not just where they are. You've got to consider where the beneficiaries are, who you're leaving your wealth to, where are they resident, where they're going to be resident. Do we need to consider the tax position in that jurisdiction? So if you're living in France and your beneficiaries have moved to Spain, you have to consider those two countries as well as the UK. Okay, so residence beneficiary is key, and UK trust structures, including pensions, UK pensions, may not always be the best vehicle. And I think it would be sensible with all of your clients that have got that one foot in the UK, who've built up long-term pension benefits, could be in all sorts of different schemes, DB, DC, company, personal pensions, and then think about where they are now in the world. And does that still fit? Is it still the best tax efficient vehicle, or should there be consideration to think of splitting them, moving them, transferring them into different vehicles, not always necessarily pension, if depending on how they look. Okay. Hopefully that gives you an overview of the civil law complexity around this. And David and I are now quite happy to take on some questions. Back to you, Paul.
Great stuff. Thanks for that, Mike. Thanks for that, Dave. We could have spent a whole day on this topic based on the various jurisdictions where we have support and advisors. So very much a snapshot this morning with the session. Hopefully you found it useful. But as I say, you can always look to deal with the guys on a one-on-one basis if you have any complex cases that you want to scratch under the surface a little bit more on. And we can always make those introductions to the guys at QB. We do have some questions for you guys. So looking at a question from Darren here with regards to QROPs. Does the trustee need to report deaths to HMRC where the plan holder is a UK national, or does it depend on how long they've been non-UK residents, i.e. only if the death occurs within 10 years?
Yeah, thanks, Darren. How are you? Hope you're well. Yeah, this is where the member payment provision period comes in. So within 10 years of leaving the UK, the trustees are obliged to report to HMRC. After 10 years of being non-UK resident, the member payment provision period falls away, so there's no further reporting to HMRC required, and that coincides with the fact that there's no tax on death after that period as well. So it's intended for QROPs were originally intended for people who are moving away from the UK, to allow them to move their pensions into more suitable vehicles for them being non-UK resident. And if they're non-UK resident for a long period, then you still get the benefits from that. What HMRC have put in place is certain restrictions to ensure that people don't sort of hop into a QROPs to get the benefits and then sort of move back to the UK at some time. So that's why the 10-year period's there. And it's called it's technically called the member payment provision period.
Thanks, Dave. And Darren's obviously had 2 shots of espresso this morning. He's fired another question across to us. Again, Spain, where we're all scratching our heads on occasions as to the rules and how they apply. Does holding investments inside a life assurance bond, which is inside a QROP scheme, get around any of the unfavourable tax or succession issues that there are in Spain?
No. If you're thinking of that situation, the QROPs is your tax structure. So that's the thing that the Spanish Hacienda would look at and consider as the tax structure. The underlying insurance policy, it's really just a platform for it's a vehicle for the investments. Things like your 5% and things like that don't really apply because it's just irrelevant. It's the layer of the QROPs that the money comes out of that is the taxable element, and the tax treatment is driven at the QROPS level. Down here, where the insurance policy is, that is just an investment holding structure.
Yeah, well, and one of the things that has been sort of common with European jurisdictions and QROPS is use of contract-based QROPS as opposed to trust-based QROPS. And it's fair to say that lots of European tax jurisdictions do look through trusts and do look through trust-based QROPS, and that's where contract-based QROPS can have some advantages. But as Mike and Paul have said, Spain seems to be sort of a rule unto itself, really, and these cases that Mike referred to that we've sort of come across recently, there's further distinctions now seeming to be made between occupational pensions and personal pensions. Occupational pensions are recognised as pensions, and that seems to be fairly straightforward. But when people start to sort of move into personal pensions, where they've got potentially more control over it, unfortunately, the name self-invested personal pension, the self-invested element, I think, seems to sometimes cause issues because the tax jurisdictions perhaps think that the members got more control than they have got. They don't fully understand. The issue with a trust, as we talked about, is that decisions are at the trustee's discretion. It's not within the members' control, and contract-based takes that further as well. So there's still some complexities within Spain to sort out. But I agree with Mike, Darren, that using a bond underneath the QROPS wouldn't overcome those.
Okay, and then we've got another question here coming from Cedric, relating to your French example earlier on, Mike, where you were looking to have the 7.5% tax on the 90% of value. Would there also be an additional 17.5% social charges on that full amount levied as well?
No, I don't think on the 7.5% is a set amount. There's obviously the other 10% is taxed at a higher amount, but no, I don't think there is the social taxes on that. I'll come back on that just to double confirm it. I'll drop a note back to you, Paul, on that.
Thank you. And I think a few more.
No, contradicting myself. I'm not sure. I need to double check.
Okay, and just had one in separately on international SIP schemes, where the member dies after age 75, and there is the income tax due on the benefits paid to the beneficiary. Where there is a sole beneficiary and they're non-UK residents, can they avoid those UK income taxes with an NT code if they live in a country that has a double tax agreement with the UK? Yeah,
potentially. I mean, it's where the member's UK resident that the issue occurs. If the member's not UK resident, then the income's being paid out of the UK SIP, then it's the same approach as with anyone who's applying for an NT tax code, I think. So, the member's non-UK resident, there's no UK income tax due. Normally what happens is that a first month's income and nominal income payment is made by the trustees, and that allows HMRC to give a tax coding, and NT is just no tax, it's non-resident tax code. So if that's then given, that allows the SIP trustees to pay the income gross under the double tax treaty, and it's taxed in the country of residence. Obviously, double tax treaties in themselves can be complex, and some double tax treaties allow for taxation in what they call the first contracting state, which is normally where the pension is, and some allow for taxation in the second contracting state, which is normally where the member resides. So that in itself can be complex. But yeah, if the member's non-resident, then quite often there won't be any UK income tax due on there.
Great stuff. Thanks for that, Dave. I think that exhausts the questions for this morning, but obviously if anyone who's registered today does have any further questions, we can always bat them past Mike and David for a response. And as I said earlier on, it is quite a complex issue, especially when you factor in all the various jurisdictions where we have supporting advisors. So if there are any questions of a technical nature, we can feed them through to David and Mike to assist you going forwards. So that's it for the session today. There will be no Pulse webinar next month. We'll be taking our summer holiday, so we will be back in September. Keep an eye out in your inbox and you'll see the invite, and also on LinkedIn in the usual channels. As always, if you have any colleagues who you think that today's session will be useful for, encourage them to register for future sessions, and we will make sure that within the next 48 hours, a recording of the session is available today with access to the slides as well. So it just leaves me to say thanks once again to Mike and Dave for your input today, and look forward to seeing you all after the summer break again in September. Thank you very much.
Thanks, everyone. Thank you.